Let's say you really like tech companies, but you don't know how to find the best tech stock. So let's create a tech index fund. So remember, an index is a group of stocks. And in this, we're going to create one right now. Let's put in Amazon, AMZ, and these are the ticker symbols. Facebook, Google, what's another tech stock? Apple, AAPL. So now we have just created an index, which is a group of stocks. Now, if you want to invest in this group of stocks and you don't want to individually invest in all these companies, you can invest into this fund. So now this has just become a fund. This fund invests in these individual stocks and you can buy shares of this fund. Now, you're not going to be the person that's actually creating the fund because there's a lot of complexities into that and they get a lot bigger than this. I'm just showing you kind of as an example of what an index is, but you as an investor can invest into a fund which invests in a bunch of stocks. That way you don't have to try to find the best company to invest in. The reason passively managed index funds have become so popular is because back in the day, the only way that you could invest in funds was by investing in what's called actively managed funds. Here's the thing, someone or something has to manage this index of stocks, because if Facebook goes out of business because people don't want Facebook anymore and people stop buying Apple iPhones, then what's going to happen to this fund? You're going to have only some stocks that are doing well and all these stocks that are going bankrupt. And if that's the case, your investment is going to tank. So someone or something is going to have to actually manage this fund to make sure that the stocks in here are doing well. And you're not going to be the one doing that, because the whole point of investing in this fund is so that you don't have to do all the work. In actively managed funds, what would happen is you would have this person right here manage this index. So let's draw a nice mustache on this person. And this person probably went to Yale for undergrad and they went to Wharton for business school for their MBA. And to most people, that means they're probably very smart. Now, to me, I'm sure they're very smart, but what that means to me is they're probably going to charge you a whole lot of money. And that's exactly what these money managers did. So they would create this fund and then they would charge you a whole lot of money. So this is you, the investor, and a lot of your money would go right into this person with a mustache's pocket. So if you wanted to invest in stocks, but you didn't want to put in the time and effort to research companies and to manage your stocks, then what you would do is you would hand over your money to this money manager with a mustache who went to Yale, who went to Wharton, who is now going to charge you a whole lot of money to take your money and put it into this index or fund that they are managing. And if your index, your investment goes down, they're still going to charge you a lot of money. This model is why index funds, as we know them today, were created. Now, I have nothing against mustaches, but I really like the idea of people being able to invest their money without paying all their money in fees. The way it worked is, instead of having this guy with a mustache manage your money, how about, and let me erase the mustache and the person, how about we just have a computer manage your investments, because computers are a whole lot cheaper to manage, and we can just tell the computer, hey, why don't we just create this investment where this fund invests in the top 10 tech companies. And now if Facebook goes bankrupt, this computer can automatically kick Facebook out and put in a new company. So this was automation coming into the money management and investment game, because now instead of paying an expensive money manager, people can create an algorithm of what type of companies they want to invest in. And so if you want to invest in the top 10 tech companies and one company goes below that threshold, this computer will automatically kick this company out of the fund and bring in a new company. Like if Facebook goes out, maybe Snapchat will come in. This computer will automatically calculate that and make these transactions. That way your fund has the stocks that you have in the algorithm. Two things happen when you do this. First, you as the investor, you get to save a whole lot of money, because managing a computer is a whole lot cheaper than paying a money manager who went to Yale and who went to Wharton to manage your money. And second, you get to take the emotion out of investing. The reason so many people, including high-paid money managers, lose money in the market is because people are emotional beings. When the 2020 pandemic hit and the stock market crashed, do you want to know what a lot of expensive money managers did? They sold. They were selling stocks out of their fund out of fear. If your fund manager makes bad trades and you lose money in your investment, but you also have to keep paying your money manager. Look, there's a time and a place for actively managed funds, but if you really want to get the good money managers, you need a lot of money to invest with them. So now we're talking millions of dollars. If you don't have millions of dollars to invest, chances are you're not going to get access to the greatest money managers. passively managed funds let you invest your money into stocks while paying low fees, and a lot of times these passively managed funds will get you better returns than actively managed funds, and you get to pay way less in fees. But in order for index funds to build you wealth and really make you money, you have to invest in them the right way, because this isn't one of those things where you can just invest in an index fund on Monday and expect to be rich by Wednesday. Index fund investing is a long-term wealth building tool, and the way you make the most money and build the most wealth by investing in index funds is by investing money consistently into the index funds and investments that you have. So this is investing money every week or every month into your funds. Now, investing has risks, okay? You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. But let's take a look at this. So VOO is an index fund created by Vanguard, and VOO invests in the top 500 companies in the stock market. Okay, so VOO is that index fund and invests in these top 500 companies. So now what you can do is you can invest into this fund. Again, I'm not telling you what to buy, just an example. And this fund gives you exposure to the top 500 companies. Between November of 2010 and November of 2020, VOO, this index fund, returned an average of 13% a year over the last 10 years. This doesn't mean that the fund went up by 13% every single year consistently. It means some years it went up more than 13%, some years it went down by 13%, but on average over those 10 years, this fund went up by 13% a year. Let's put this in perspective. Let's say you had $10,000 and you put this money into the bank. And I'm gonna be very generous, and I'm gonna say that your bank paid you a half of 1% a year in interest. If you did that over 10 years, your $10,000 would grow, and it would grow to a whopping $10,500 after 1 decade. If you put your $10,000 here into this index fund that gave you general exposure to the stock market, then your money would have grown from $10,000 all the way up to $33,000. And this is on the side without you doing any work. You just put your money in and then you go do something else. Now, I get it. Hindsight is 20/20. Of course, it's easy for me to look back and say, hey, you should have done this. But this is the reality of how investing works, okay? If you don't take risks, your money is not gonna grow.